Hello.
Good evening.
Good evening to everyone. So let's continue with what you mentioned regarding the presentations. And the first one that I have here is Bulgakov. Is he here?
He is in another group.
Okay. And then the other one is Kuzovkova. How do you say it?
She's not here at the moment.
Okay. And then next one is Kirill.
It's me. One second. So I will begin. I want to talk about European regulation of derivatives. The first regulation of derivatives and the financial market was introduced in European Union in 2007. It is MiFID I. So MiFID stands for Markets in Financial Instruments Directive. And it was in force until 2018. The purpose of this regulation was to build a fair, transparent, efficient, and integrated single market of the European Union. But the crisis of 2008 demanded a new regulation that will be more resilient. So MiFID II and MiFIR was introduced. And only by the fact that now the regulation the regulation is not in form only of direction, but also in form of regulation. Only by this fact we can consider that the regulation become harsher because the directive may be differently interpreted by member states because they have to implement this regulation into their national regulation. But MiFIR has the direct force. And so this regulation is in force currently. And one more fact is that in MiFID I, there was little attention to regulation of derivatives, while in the new regulation pay more attention to derivatives. So let's take more attention to current regulation about derivatives. So MiFIR II pay attention to not pay attention, but require pre-trade transparency, post-trade transparency of derivatives. So it requires that current bid and offer prices have to be published by financial institutions. And after the trade, also price and volume and time of transactions have to be published. Interesting fact that this information have to be published on commercial basic. Commercial. So have to be provided on a reasonable commercial basis, but after the 15 minutes after the publication, the information from this time have to be how to say it, have to be free of charge. So what MiFIR also require, it requires that all transactions on derivatives have to be concluded on regulated markets, MTFs and OTFs. And moreover,
Kirill. And why the information should be published?
Information should be published to make the market of the derivative more transparent.
Good. So, that's all. And then why that? We need transparency.
To make it, I think, more efficient. Maybe more, make it more secure. So, moreover, in this this regulation, for example, also require that traders to record all their phone calls about the transactions, and they have to store them. So it's
yeah, and why we need transparency? Because if there is no transparency, there's a little bit of noise there. Sorry. If there is no transparency, what happens? Then you can have similar transactions, similar at very different price. And then in this way, you can cheat the clients. Yes? Okay, so let's say that Joseph is a friend, and then Nick is not your friend. So, and both of them are your clients. So what do you do if there is no transparency?
I will sell my derivatives to my friend cheaper than to my not friend.
Okay, and then and even smarter could be that you make a trade between Joseph and Nick directly, no? But then in this way, because Joseph is your friend, you try to make a trade that is more advantageous for Joseph, is more favorable for Joseph, no? And you will damage in this way Nick. And then maybe Joseph can invite next time in his dacha, no?
Yes, I agree.
Yeah, okay. So this is the thing. What is the difference between MTF and OTF?
As I understand, so this is the terminology of the regulation. So in OTF, there were no equities, and on MTF we can sell more exotic instruments than on just regular markets, exchange.
Okay, let's go ahead.
May you repeat what you say?
Yes. Let's move forward. Let's go ahead.
Okay. So also all transactions have to be cleared by a CCP. So yeah, it's the end of my presentation.
That is the end. And what about, can you say something about this central CCPs? Why we need CCPs? What they are for?
They take credit risk of the counterparty.
They?
And
Sorry, say it again. They?
CCP take the risk of the counterparty.
Say it better. Think about and say it better.
So in general, as I understand, CCP produce transactions. So for example, one side have to sell derivatives by particular time. So, and if the other side, for example, want to execute the option, so this CCP conduct this transaction.
And then, this is true. And then, thanks to this,
so due to this, the transactions are more safer. So
okay. So this is the thing that there is they act in a way that they can clear the transactions, so you are safer as a customer. Okay? That is the thing. Good. So clear. That's fine. So let's move forward. Yeah, next one is Kuchkov. Belongs to this group or not? Dimitri. Kuchkov.
No, he's in the other group.
And Leonid as well, I guess, no? Lashkov.
Also in the other group.
Yes. And then Markova,
And she's also in the other group.
And the next one, I guess, is not from our group as well, Maxim. So
very good. So next one is Miroshin.
he answered in the previous class. I mean, last week.
Yes, okay. And then Rina, Vasianina.
Yes. Okay, hello everyone. I want to remind you some theory about options. So an option is a contract that gives the holder the right to buy or sell an asset at some date in future at a price agreed upon today. The seller of an option has an obligation to give the buyer this right. The right is not an obligation, so the buyer can decide whether to exercise an option or not by himself. The buyer also pays to the seller some amount of money that is called option premium. And in economic sense, an option premium is a payment to have a right to make a deal in the future. There are two types of options by execution, an American and European. The American option can be exercised on any date before the expiration date, and the European option can be exercised only on the specified in the contract date, so in the expiry date. Depending on the position of the strike relative to the current market price of an asset, an option can be in one of three states: in the money, at the money, and out the money. In the first case, the seller of an option pays the buyer the positive difference between the strike price and the current market price of an asset. In the intermediate case, exercising the option will result in a zero payoff because the exercise price will be equal to the spot price. And in the last case, exercising the option would result in a negative payoff. So in such cases, options are not exercised. There are two basic types of options by action: call and put, and each of them can be either bought or sold, as you already know. A call option.
Arina, just a thing. Normally, go back, please. So here you can define what is the payoff, no? But normally the payoff is the formula that you have in the next slide. This one.
Yes.
Normally is that one. So negative payoff cannot be.
Yeah.
Yes.
Yes, you're right.
So if that is the definition of payoff, it will never be negative. So you can say instead of negative payoff, you can say something different. So what is
a risk premium, option premium that you have paid?
No, it's not the premium. Then you can see that the difference between the strike and the value of the stock of the underlying is negative. That is something different. No? But again, if you define this as payoff because of that marks cannot be negative.
Yeah, right.
Yes, that's it.
Okay. So call option gives the owner the right to buy an asset at a predetermined price in the future. The buyer here is interested in the price growth before the expiry date. And if the call is in the money, its price is a positive difference between the current strike price and the current price of an asset and the strike. Here is the graph. A put option is something opposite. It has opposite effects. So it gives the buyer the right to sell an asset in the future at some pre-agreed price. The buyer here makes profit only if the price goes down. And if the put is in the money, strike is a positive difference between so the price is a positive difference between the strike and the current market price of an asset. So an option price at expiry, it consists of two parts: the intrinsic value and the speculative value. The intrinsic value is calculated mathematically, is the difference between the strike price and the current price, and speculative value is the difference between the option premium and the intrinsic value. There are several methods to value an option. One of them is binomial option pricing model. It has a replicated intuition, so we consider a discrete time path of the instrument price and calculate. Another method is risk-neutral approach. It is in some kind similar to the previous one, but it uses a calculated risk-neutral probability of an upward of the price. And furthermore, there is Black-Scholes model. I guess you know, you're familiar with it.
Yes, Alina, just a question. Go back, please. So, what is the definition of risk neutral?
Risk neutral?
What do you mean by risk neutral?
It's a probability of an upward move of the price, and it uses risk-free rate, maybe.
No. That is not the definition of risk neutral. Who knows it?
Mm,
May I answer?
Yeah, of course.
When a person is indifferent, when he or she makes an investment decision.
Arina, when you trade on the market, you have to split the decision in two parts. First part is how much this asset is worth independently on your preference,
mhm,
risk preference.
mhm,
So in order to have the same price, you, Otabek, and Joseph, and Kirill, you need to have the same term of comparison, the same metric. It's clear what I mean?
mhm.
Yes or no?
Yes.
Good. So then you do the evaluation independently on your risk aversion.
Mhm,
The same will be for Rotabek, the same will be for Joseph, and so on. Okay. Then once you establish what is the price independently on the risk aversion, then you will decide if that price is convenient for you to enter in a trade. And a trade can be that you sell it or you buy it.
mhm,
But again, the first thing is to do the evaluation, and the evaluation should be the same for everyone. And this is the meaning of risk neutral.
mhm,
And the second is to decide, given the price that is the same for everyone, if for you that price is too high or is convenient, is cheap.
mhm,
And so in the first case, what you do, if it's too high,
mhm.
if the price is too high, what you do?
If the price is too high for me,
Sorry?
what I do?
Yes, what you do?
Lower the price.
Sorry?
Lower the price.
You cannot lower the price.
I don't buy.
Yeah, you don't buy, but if you are in the market, normally you try to enter in the market, no?
Mhm.
So what do you do? Which kind of deal do you do?
If the price is too high for me, I want to enter the market.
What you will do?
I have
Whatever?
a suggestion.
Yes, Nick, say it.
I can somehow, diversify my risks, and in this case, this high price won't matter to me so much if I have an ability to do that.
Otabek?
Could you please repeat the question?
Yeah, Otabek, please pay attention to the class, okay? Then in 30 minutes we finish. I know that your time is very precious, but in this moment we are working on this class. So 30 minutes and then you do whatever you want.
Mm-hmm.
Yes?
Okay.
Good. So if an asset is very high, in your opinion, the price of an asset is very high, what do you do?
I can borrow some money.
Yes?
I can borrow some funds.
Nick, Arina, you sell it, you go short.
Mhm.
It's clear? If you think that something is overvalued, you short it.
Yeah.
You go short.
Mhm.
And then what you do if the price is little, is cheap for you?
I go long.
Exactly.
Mhm.
So let's go on. So now we know what is the meaning of risk neutral, correct?
Yes.
Good. Let's move forward.
Options can be combined by traders who want to achieve different goals on the market. I want to tell you about some strategies. Briefly, protective put strategy. It consists of protection. It consists in protection against stock price decline by buying a put option for this stock. For example, you buy a stock at 40 and a put option with an exercise price of 50. And if the stock price declines, you will be protected by your put option. Another strategy is a covered call strategy. For example, here you buy a stock at 40 and sell a call option with excess price of 50 and so get $10 premium. And if the price will go up, you will protect yourself from paying too much by your stock. This is the protection from unlimited loss. Another strategies are straddle positions. When investor enters a long straddle position, he simultaneously buys and sells call and put options for the same stock. So he buy call, buy put with the same excess price and for the same time. He needs to pay two premiums. And what about payoff? If the realized price of an asset is near strike, he will lose money. And if the price will go away from the excess price, the investor will gain profit. In the short term,
Go back, please. When you enter in this kind of deal,
I will enter this position if I expect price fluctuations, big fluctuations of the price.
Yeah, so when you expect that the volatility is high, no?
Yes.
Okay. Let's move forward.
And the short straddle position is something opposite. I will enter this position if I don't expect high volatility. And here I will sell on the same call and put options. So it's something opposite.
Okay, so go back, please. And what is the risk in this case?
The risk is high volatility. So I will.
Yes. If the volatility is high, what happens? What happens?
I will lose money.
Yeah, you lose money, but if you see, you don't lose just some money, but you
there is
will.
potential infinity loss.
Exactly. So that's why there are different kind of strategies that can help you to limit the loss, no? Because this is very dangerous.
Yes.
No? So go back to the previous slide. You see, yeah, the loss, maximum loss is fixed. No?
Yes, two premiums.
So in this case, in your payoff is minus 20. No, that is the maximum loss that you may have.
Yes.
No.
Yes.
Instead, the other one is very dangerous. No. And in general, every time that you short derivatives, you have problems. In the sense that the risk is very high.
Yes.
It's clear to everyone this?
Yeah.
Good. So, do you have questions for Arina?
Yes, I have one question. Can you explain, please? Straddle is a strategy when we buy put and call for the same price, yes?
Yes, we buy the same the opposite put and call, the price, the excess price is the same, the expiry date is the same, and the underlying is the same here.
Okay, thank you.
Anton,
Yeah.
follow the colors. So the first one, I don't know, the red one. What is it? Can you see it?
Yes. It is long put, I believe.
Very good. So that is the long put, no? And Arena has assumed that the what is it? The premium is 10. Okay, that's why you are minus 10 because you buy. Okay, it's
Yes.
clear.
Yes.
And see the other one, the green one. Yes. What can you see it?
Yes.
So is a call. You buy a call, and then again you have to pay the premium. Anton?
Yeah. It's clear.
Okay. And then this premium, according to the assumption that Arina's made, is worth $10. Okay.
Yes.
And then what happens? That in the worst case, because you are a buyer, you buy the put, you buy the call. In the worst case, what can happen?
In the worst case, you mean that stock price will increase?
You think about the different options. No, what can happen to the underlying? So depending on the underlying, you have a value of the derivative, no? Because we said several times that the derivative derives its value from the underlying, correct? Anton?
Yeah.
Okay, so the price of the derivative depends on the underlying, okay?
Yes.
So you have, when you think about the risk, you have to think about the underlying. What can happen to the underlying? It's clear this, Anton?
The question is clear, but I think about answer for this.
Yeah. Let's do one step after the other, okay? Okay, so we have, when we talk about the risk, we have to check what can happen to the underlying. Anton, can you follow me? So the underlying can go up or can go down.
Yes.
And depending on this, then you have a value of the option. Hello?
Yeah. I think.
Okay, good. So depending on the evolution of the underlying, you have a change in the value of the derivative.
So maybe in the situation from the slide, we believe that probability.
There is no probability there. But if you enter in this deal, if you take this position, it means that the worst thing that can happen is that because you are a buyer, the worst thing that can happen is that you lose 20 rubles or dollars or whatever. You lose the premium because you are a buyer. When you are a buyer, the worst thing that can happen is that you lose the premium.
Yes, it's clear.
Okay, good. So This is a strategy that you can adopt when you think, as Alina said, adopt when you think that the market will not stand still, that will change.
So we want that the stock price will change significantly from
50, from the K, how do you call it? XK, Alina?
Okay.
You call it K. Okay, from K that is equal to 50. And then up, if you see this strategy, according to what Alina said, this strategy is negative. You will lose money if the stock price is between 30 and 70. You have
Yes.
the break even at 30. You have the break even at 70. But between 30 and 70, you will lose money. So in this example, the stock price has to change significantly from 50.
Okay, I get it. Got it.
Is anyone having another question? More questions for Alina?
And the short straddle, it's quite the opposite, right?
It is exactly the opposite, but this thing is also, we said, more riskier, no?
Yes, it's risky because we can have minus infinite profit, but still, if we suppose that the price will be somewhere between 30 and 60, it can work for us.
70, Nick.
70, sorry.
No,
30
it's
and
okay.
70.
Yeah, Nick, but you can have this kind of situation in the market in which the price of the underlying can move significantly. And if you think about what happened to the rubles against the dollar, no, back what the beginning of the year, you can see even more dramatic changes.
Yes. In this case, all traders who chose this strategy will lose just enormous amounts of money.
Exactly, unless you have some protection. For
Yes.
example, protection could be a stop loss, whatever, no? But these kind of strategies can be, normally you earn money with these strategies, no? But the problem is when something happens, because in that case you will lose, as you said, enormous quantity of money, and that would be extremely dangerous because you can kill the company this way, no?
Yes.
With these kind of strategies. So thank you, Alina. Let me see next one. Otabek, is your turn. Otabek?
Yeah, just a second. I'm just trying to share my screen. And yeah, it's visible now. So let's turn to slideshow. Okay. So today I have prepared a topic that is called Derivatives and Emerging Market Economies, EMEs. Can you hear me?
Yeah, I can.
Okay. So to begin, until the late 1980s, organized derivatives exchanges were limited to developed countries. However, the late 1980s and early 1990s witnessed a growing interest in launching derivative exchanges in emerging markets. In general, financial markets in developing countries are referred to as emerging market economies or emerging markets. I mean, financial markets in developing countries are emerging markets. And given the high level of economic and financial risks faced by market participants and investors in emerging countries, derivatives markets are expected to contribute to countries' development by providing hedging opportunities. However, as I have observed in the literature that I've read, the extent and directions of derivatives development raise several questions because these instruments' actual applications are way different from the reality that is supposed to be in the real world. I mean, hedging. In other words, I mean that it's expected that hedging could have taken one of the major parts in most transactions. So let's move to the first slide. And in this slide, I just want to explore the questions that I want to.
Sorry, Ottavek, to interrupt you, but I didn't get what you mean. What you meant before by hedging. What? Can you please repeat it?
Yeah, I meant that. So for unstable economies like emerging markets, derivatives could be a good tool for hedging opportunities, and not something else like FX speculative trading or like something like that. And that's the part that I wanted to explore in my presentation.
Okay.
So in this presentation, I'm going to cover 5 questions to answer some of the questions. And the first one, how big are the derivatives markets? And what are their structure and dynamics? Which derivatives are traded and dominate emerging market derivatives turnover? How does this all differ from major markets or developed countries markets? And what are the specific examples of successful derivatives markets and contracts? I mean, the market as a whole, exchange, and specific contract that was devised in one or another developing country. And so let's move to the next slide. Moving to derivatives market size and dynamics, it's reasonable to note that derivative markets in emerging market economies remain still small compared to those in advanced economies. And this can be seen in daily turnovers that in derivatives that were made in 32 emerging market economies that were selected by the BIS review, for which data was available for the years provided. I mean, April 2010, it was the first review that I've watched, and the second review was of 2016, if I'm not mistaken. And so of April 2010, it was said that in emerging market economies, in those 32 countries, derivative turnover, I mean, average daily derivative turnover was about 1.2 trillion, which is just 6.2% of those economies' GDP. And this can be compared to the advanced economies in which daily turnovers were $13.8 trillion. That is about 36% of the of total GDP of those countries. And we can see that the difference is dramatic. And even though these derivative markets in developing countries were small, derivative markets in emerging countries have expanded more rapidly overall, because average daily turnovers have increased by 300% since 2001. I mean, in the period from 2001 to 2010, and this trend was a bit different in developing countries, and it was like 250% since 2001 to 2010. And yeah, these are the figures that I have put on this slide.
Sorry,
moving to, yeah.
Stay there. To the previous slide. Go back. Yeah. No. This one. Okay, good. So, in your opinion, what is the positive side of this, I don't know, this big part of the GDP and the negative side of this.
Mhm. You mean in advanced economies, yeah? Big side of this GDP.
Yeah, or you can do the same for the developing economies.
I guess that this could be somehow, this could play a role of a benchmark. I mean, if the turnover of derivatives is high compared to GDP, I mean, for example, if it could have been like 50% of GDP a day, in this case, I think that the liquidity turnover in GDP would have been too high, and maybe those countries could have faced some problems with the leverages, because they couldn't have paid out the volumes that are in those derivative markets. Probably something like this.
Please focus on what is the title of your slide. No, what is the title?
Derivative market size and dynamics.
Size. Okay. So the first thing, size. You have 6.2% of GDP and 36. So what can be the pros and cons of this? Of 36% of GDP?
I guess that if derivative turnover is high compared to GDP turnover.
Sorry. We talk about not turnover, but size.
So yeah, but in this slide I meant that this $13.8 trillion average daily turnover is 36% of this advanced economy's total GDP.
Correct. That's it.
Mm-hmm.
And what could be the pros and cons of it?
I think that 36% could be a pros, I mean, an advantage in a way that these derivatives could be used for interest rate hedging or something like that. So some steps to provide some stability in the country, maybe.
Well, if they are used for hedging, yes. But we know that derivatives are not only used for hedging.
Yes.
So
this could be a source of new funds for the economy, probably, if it's used, for example, for forex speculations. So market participants could gain some profits from these high volumes.
well, the pros, Otabek, think about why we need derivatives, no? Do you remember? One reason is what you mentioned already, hedging, no?
Yes.
And then see the other ones, if you remember them.
Another one is speculation.
Yes. And then?
And so forex speculation and hedging, probably these are the two of the most
No, there are some more
significant parts.
Nick, can you remember them?
Not really. I just remember that they are some kind of flexible tool which helps the economy as a whole.
Sorry, Nick. That's fine. Arina, can you remember them?
Sorry, can you repeat, please?
Arina, the same rule for you, no? Try to focus on the class.
Okay, so
In 30 minutes we finish. So try to focus on it. Vladislav?
Yeah.
So do you remember the benefits of derivatives?
Please, can you repeat it because I didn't hear.
What are the benefits of derivatives?
Derivatives can make more profit, and it is more risky, but it is more profit for investors. That's due to the risk of high risk. Investors on the funds. It regulates to not every investor can buy derivatives.
Anton, we already mentioned those two things. Hedging and speculation is what already Otabek mentioned. Do you have anything to add?
Also, we talk about insurance.
Well, insurance is hedging, no?
Yeah.
But I don't know, Joseph, let me try with Joseph, maybe he knows or remembers something.
The other benefit for derivatives may be access to unavailable assets or some sort of this.
Good. This is one thing. Second? Okay.
The other, I don't know.
We said leverage. Otabek, do you remember leverage?
Yes, I mentioned it,
I can't remember.
but not as an advantage, of course, not as an advantage.
Okay, I was talking about that. So the advantages, so we said hedging, price discovery. Do you remember price discovery?
Yeah.
Okay. And liquidity. And so
This was mentioned as well.
Okay, so there are several reasons, no, for which we want derivatives. So this is the positive side, and the negative side.
Leverage could also be on the negative side as well. The risk of losing more than, so you just increase the risk of your.
Yeah, we kind of increase the risk if we have positions like what Arina showed us, no? That we are short derivatives, no? Short. But one thing is that maybe I mentioned, but I'm not sure. Can you read the chat?
I should leave this one and open the chat. Financialization of the economy.
So what is the point? That when the Americans said we had, after the Second World War, there was an agreement to have the dollar as international currency for reserve and for trading. So all the trades were expressed essentially in dollars. Yes? Can you follow me? Instead, Keynes, do you know Keynes? This person?
What?
Keynes?
John Maynard Keynes.
Correct. So this guy said, well, this thing can lead to big problems. And we did another solution that he proposed, another currency that he called Bancor. Well, but this was not accepted, and you know, the US had a big power, and then everyone at the end agreed that the dollar should be the international currency for the world. But at the time, the dollar was pegged to the to gold. It's clear what I mean by dollar peg and pegging to gold.
Yeah, it's a gold standard, right? Dollar's value depends on the gold.
Exactly. So you could go to the treasury of the United States and you could exchange fixed for a fixed number of amount of dollars. You could exchange dollars against gold. Okay. But then in the 70s, Nixon said, we can't, we printed too much money, too much dollars, so we can't pay our in gold our dollars. We cannot exchange anymore the dollars in gold. It's clear?
Yeah.
So given that, starting from that point, then the central banks, especially the United States, can print as much money as they want without any limit. So if this is true, then a big part of the wealth of Western countries is based on something that does not exist. Is an illusion. Because Russia has, I don't know, gold, as oil, as gas, whatever, no? But what the United States needs to get this from Russia?
Just the United States should pay for the resource to.
So what the United States do in order to get this from Russia? So in order to get oil from Russia?
Buys this oil on.
In which way they buy oil?
Probably for Russian rubles. I'm not sure. I'm not pretty informed about this process.
Well, normally we said that the trades are made in dollars. So what the United States can do then? In order to buy oil. Exactly, Nick. Print dollars. How much is the cost to print dollars? Yes, and then if those dollars are just records in electronic records, not even cents. So in exchange of something that is that is real, no? In exchange of oil, the United States just print dollars, and the same is for applies for China, no? What they do, the United States, to get I don't know the industrial products from China.
So again, print dollars.
Print dollars. So this is the thing. This is when the problem of Western countries is that the big part of the economy is based on something that does not exist. So they print the big part of the GDP is based on illusion, on something that does not exist. And And again, by printing dollars, they can get iPhone, they can get oil, they can get gas, they can get gold, and so on. It's clear what you mean?
Yeah.
Okay, good. So let's move forward.
So, okay, yeah, I'm gonna move forward. This was about the derivatives market size and dynamics, and now I just wanted to move to the derivatives turnover structure in overall. I mean, not in specific country, but in the whole market as in the period from 2001 to 2010, especially in 2010. So, regarding the derivatives in emerging markets, it's clear that over-the-counter derivatives are relatively more in emerging markets than in advanced economies. You can see this by the fact that in emerging markets, derivatives are traded in almost equal proportions over the counter and on exchanges. I just wanted to show it on this chart, which is on these two charts where we compare two types of economies, for example, advanced economies and emerging economies. And we can see that over-the-counter derivatives are traded almost in equal proportions on exchanges and over-the-counter. So yeah, that was the point. And on the other hand, we can see that in advanced economies, this proportion is a bit different because almost 2/3 of derivatives are traded on exchanges. So we can see that exchange-traded derivatives are just 2/3 of the total derivatives turnover in advanced economies. And yeah, this is the fact. To say that over-the-counter derivatives are probably more important for emerging markets than for advanced markets. So then derivatives in emerging markets are also mainly used to hedge or to speculate on exchange rate, and to lesser extent to mitigate equity market risks. So we can see this also on the same chart that in emerging markets, derivatives are mainly used to hedge or to speculate on exchange rate. On exchange rate, meaning that in some foreign exchange markets. So by contrast, if we contrast this with advanced economies, derivatives in advanced economies are used by large proportion to trade interest rate risk. And we can see that also on the same charts. I mean, these two charts are the main focus of my narrative on this slide. So by seeing that 77%, about 77% of total derivatives turnover is in interest rate risk mitigation. However, we can see that FX derivatives account for about 50% of emerging market economies' derivative turnover. So this small number in here, and about.
Stop there. So why is like this? Why the majority of derivatives is for emerging markets in FX?
So it's probably the case that in emerging economies risks are too high, and it's probably kind of harder to call for sufficient liquidity for risk mitigation. I mean mediation. Then for foreign exchange derivatives trading. I mean, there is a more liquidity probably for foreign exchange derivative exchanges because derivative trading, because a lot of the deals in emerging economies are not made in the economy themselves, but somewhere cross-border. This is probably my hypothesis.
Kirill?
Yeah, I don't feel, I think that maybe as Otabek said, that emerging markets use foreign currencies, while advanced economies use their own currencies.
Very
maybe
good.
in some
Exactly. That is the thing. That is the thing. Otabek.
Again, could you repeat it one more time?
Kirill, say it again.
Developing emerging market economies use foreign currencies, while advanced economies use their own currencies. So there is less share of this kind of FX derivatives.
Okay, yeah, that point
So
also
that
was
is the thing.
was part of my narrative.
That is the key. So we mentioned the United States. No? We said that they can just print dollars to buy everything they want. Similarly, but not at the same extent, all the other developed economies. So, for example, United States, Europe, Japan, and United Kingdom. There, they can exchange goods sometimes by using their currency. So that is the reason why for emerging market economies it's much more difficult to keep the terms of trade fair, because they cannot use their currency for buying whatever. They must exchange their currency into euro, into dollars, into whatever. So, and this is the problem for them, because in this way they will get poorer and poorer, no? And their economy is destabilized because of this. They cannot print money. In order to get something from the market, they must sell real things, like what we said before, wheat, oil, wood, whatever. This is the problem. So let's move forward.
I guess.
Yeah, go ahead, Nick.
I guess they can try to trade in their own currency, but because of the unstable situation in those countries, those trades will be just too risky to execute at all. In dollars, they are more stable in that sense, but more expensive.
Yeah, you are right, Nick. But why the dollar is more stable? Because there is a huge benefit to print something that doesn't work for anything, but is accepted everywhere. For this reason, it's more stable.
I thought it was due to the policy of FED. Well, was
which policy, sorry?
Until sometimes. I thought that the dollar was the main currency traded because of the, how to say, accurate policy of Fed in the US.
No, they started with this policy, as I said, at the beginning of the 70s, and then did you ever read about helicopter money?
We know what that is, yes.
So, is this quantitative easing?
Is that what?
Quantitative easing. QE.
Quantitative easing?
Yes.
Is it somehow related to helicopter money?
Yes, it's simply.
So as far as I know, helicopter money is when money printed is not printed money is not the reason of a long-term growth. I mean, of real growth, but some short-term.
Well, they started with this when there was this crisis in 2007, 2008, and this crisis started in the United States and then spread across the world. So quantitative easing is this thing, and this approach was adopted by several countries, mainly developed countries. So it's about printing money as much as possible. So that is the thing. So Nick, you are right that the dollar is more stable, but the stability is because of the result we said before that, well, you can destabilize any country if you impose to that country to trade not in your local currency, but in the currency that you want, and in this case, in your currency.
Okay.
That's why there is a movement to change this situation. So now some countries like, I don't know, India, China, Russia, and so on, Iran try to trade in local currency. And in this way, they can try to avoid the problem that we said before. So let's move forward.
Yeah. So
I
just want to recap that. I just wanted to recap that in emerging markets, as we have observed, foreign exchange derivatives account for about 50% of total turnover, and equity-linked derivatives for 30%, and the rest is for interest rate derivatives. And in contrast, derivatives in advanced economies are used by large to trade interest rate risks, and this could be seen in 77% of total turnover, with foreign exchange derivatives and equity-linked derivatives being probably less important in this case. And I think that these differences reflect some kind of depth and liquidity of bond markets in developed countries, and probably limited concern with the exchange rate and risk in advance compared to emerging market economies. Because advanced economies probably less concerned about their exchange rates risks. And in addition to this, it's worth noting that as a matter of fact, I've said that in developing economies, foreign exchange derivatives turnover is important, and probably this was one of the causes for their kind of good development of these FX instruments for these trades. And as it was mentioned in some of the papers that I've read, foreign exchange instruments and over-the-counter markets in emerging economies have already converged to advanced economies trading patterns. In this way, I mean that foreign exchange instruments, some of the foreign exchange instruments that are traded in the emerging markets over the counter have already converged in their proportional distributions to the ones that were observed in proportional distributions of developing economies. And it's also reasonable to add that to add the information about the dominance of the US dollar in developing economies, because 85% of all the emerging market transactions in derivatives markets were dollar denominated. And this is probably the case why this is probably the case for the situation that their local currencies are not traded internationally, and they are supposed to exchange their local currencies for more liquid US dollars. Yeah. So this was the case. We have covered up some derivatives market size and dynamics, derivative turnover structure, and now I just wanted to shed light on some successful examples of some interesting on the one side KOSPI 200 derivative contract and the Brazilian derivatives exchange as a whole. So in this case, I would say that for a success measure, I have taken two examples that were probably whose success on the one side is based on the volumes that were traded, and on the other side, it's I just want to shed light on the Brazilian derivatives exchange that was successful in mitigating, not in mitigating, but in that successfully acted in some world crisis. I just want to start from the Korean Stock Exchange Index Futures contract first, which is KOSPI 200, that was introduced in May of 1996, and when Korea was an emerging economy. And the Korean futures market has been among the fastest growing derivatives in the period from 1996 to 2003, by leading to the fact that in 2003, not in 2003. Yeah, in 2003, Korean futures market has been among the fastest futures contract traded, and reached the point when it was top 3 in the total futures contract trading ranking, by volume, and top 10 among all of the derivatives in 2003, if I'm not mistaken. On the other side, we can take a look at the Brazilian economy that was, the Brazilian exchange that was created in the Brazilian economy. Also, what I wanted to say, I have mentioned that Korean futures contracts were ranked high in the global markets, and this success could also be attributed to speculative trading motives rather than some hedging motives, because probably most of the liquidity was provided internationally rather than by local markets of the developing market economy of Korea for that time. So also another example of successful derivatives exchange, in this case, not contract. I just want to talk about the Brazilian derivatives exchange that was introduced in the 1990s. And it was specifically an onshore derivative exchange trade that traded mostly foreign exchange and interest rate contracts, in addition to commodity and non-deliverable instruments. By non-deliverable, I mean that they were traded in local currency compared to some other developed country exchanges that traded in US dollars. So this was due to the fact that Brazilian legislation framework constrained over-the-counter trading, and this probably encouraged the migration of trading on exchanges. So to the migration of trading on exchanges and its and Brazilian derivatives markets development. And specifically, this exchange was successful in terms of resilience in some of the world's significant crises. And the first one was East Asian financial crisis of 1997. The second one was the Russian debt moratorium of 1998. The third one was the Argentine default of 2001. And the third is about the global financial crisis of 2007 and 2009. And there were also other crises in the future, in the period from 2010, say, to 2018, but I've shed light on these ones. So yeah, that's all.
Okay, that's fine. Now I suggest some readings about this. This is about a book that could be helpful by Adam Tooze. Then this is about the financial crisis that you mentioned, no? And then you are also you can read also this this commission. The idea to a union to have a different different currency that like the Bancor that I mentioned before. The Bancor, just giving you the reference. Can find something here. The Bancor is this one. And then, well, there is an important economist in Russia that can explain also this. Glaziev. Do you say this in? Do you name it in this way? Glaziev. Hello. Can you read this?
Bancor.
Yeah, we can see.
Who is Glaziev?
He's a Russian economist that talks about what we mentioned before. He's
Okay, thank you.
okay. So, in case you are interested, you can read some paper of Glaziev, and then about the Bancor and so on, the crisis, and then if you need more explanations or more reference, you are free to ask. Okay. Okay. So I wish you a nice evening then. All the best.
Thank you.
Thank you. Goodbye.
Goodbye.